What's going on, everyone? My name's Jose, and today I'm going to be talking to you guys about the 5 best ETFs that you can have in your portfolio so that you can start investing and be super diversified. Before I start this video, please make sure that you smash the like button and subscribe. This always helps out the YouTube algorithm to promote my videos in other pages so that I can get exposed. So for those of you that don't know, an exchange traded fund is basically like a little basket that holds a bunch of stocks of other companies. So basically you put in money into this ETF, an exchange traded fund, and you're basically going to be diversified over hundreds if not thousands of companies that are in the S&P 500 or the NASDAQ or the Dow Jones, etc. So without further ado, let's get into these 5 best ETFs that I think everyone should have in their portfolio. If you're a beginner, this will be definitely essential for you because this is going to basically put you all over the map in a good way. You'll be so diversified that you don't have to pick individual stocks in order for you to start investing. Honestly, ETFs just make it so much easier because you don't have to think about like, oh, how is this one stock doing or how is this one company doing? Since you're invested in so many other companies within that ETF, it just gives you, some sleep at night and you'll be fine. Just keep in mind, I'm actually not putting any of these in any particular order. I think all of these, if you have them in your portfolio, will be amazing. So the first one that I have on my list is QQQ. So QQQ is a technology company. It's been doing really well over the past couple of years, and it has holdings in Apple, Microsoft, Amazon, Alphabet, which is better known as Google. Alphabet owns Google, and Facebook. Their expense ratio is only 0.20%. So what that means is out of every single $10,000 that you add, they're only going to charge you $20, which is amazing over the course of years, obviously. And they also give you a $1.62 dividend per share. Remember, this is broken down into quarters, so divide the $1.62 by 4, and that's what you get per share per quarter. The only negative side of this ETF is honestly that it has 37% of their holdings in Apple and Microsoft combined. Honestly, I don't see Apple or Microsoft going down under anytime soon, but since the ETF holds 37% of their total assets into these two companies and they go under, then what are you going to do? Exactly, your ETF or this investment could go down. That's the only negative side. But like I said, Apple is a leading company. Microsoft, obviously everyone knows Microsoft for the most part, and they're doing really well right now. So this ETF is definitely a good one to have in your portfolio. And for the second ETF, I want to definitely recommend this one. This is Vanguard's VOO. I own some shares in VOO. My daughter owns some shares in VOO, and I think is one of the best overall ETFs. That's just my opinion, and I love putting money into it because you definitely see the outcome and the gains and also the dividends, which I love. Just like the name says, the Vanguard S&P 500 ETF, this one just tracks the S&P 500, which are basically the best 500 companies, Apple included in there, Microsoft, Google, Facebook, Amazon, all of those big boys. The reason I love Vanguard ETFs is honestly because of their low expense ratio. This one comes down at a 0.03% expense ratio. So every $10,000 that you invest, they're only going to charge you $3 a year, which is, amazing. That is honestly one of the lowest. Vanguard is known for charging the lowest expense ratios. So I love them for that, and I always recommend Vanguard for those things. All right, and the third one that we have for you guys is the SPDR 500 ETF, which is SPY. This is probably one of the oldest ETFs and has a great track record, honestly. And this fund also tracks the S&P 500, similar to the VOO. Their expense ratio is 0.09%, so every $10,000 annually only charges you $9. I think this one is very good. It's honestly on the higher end of the the ETFs that I've mentioned before in price wise, but honestly it's an extremely well-funded, well-managed fund. And the fourth one that we have for you guys, I actually mentioned this one in my M1 Finance, that I think is a very good ETF. It's a Vanguard Total Stock Market ETF, VTI. Honestly, one of my favorite ETFs just because it's super diverse. I think it invests in about 3,600 companies and they're all well-known companies. So honestly, your money is in a safe investment and you can rest assured that it's doing well. You can look at Vanguard's VTI track record and it's through the roof. It's honestly amazing. And this stock, I recommend it to all beginners or people that are just getting into the market, just because it is so diverse. It just gets you so into so many different types of industries. It just makes it really well for your portfolio to perform better. This one also has an expense ratio of 0.03%. So every single $10,000 you spend, they are only charging you $3 for it, which is, like I said, amazing. And for the fifth and final one that I think everyone should have or try to get into is the Vanguard High Dividend Yield ETF. So this ETF focuses on holdings with high dividend stocks like Johnson & Johnson, JP Morgan, Procter & Gamble, Intel, AT&T, Pfizer, Exxon, and so many other companies. This is also a pretty diversified ETF itself because it's in so many different types of industries. Like how I just mentioned, you got Johnson & Johnson, which is in the health industry, and you also have Chase, and then you have AT&T, and then you have Exxon. So you can already tell that this is a very diversified ETF, which I love. I love diversification. This expense ratio comes in at a 0.06, which is not too bad. Honestly, it's still, $6 when it comes down to every $10,000 investment. And they're also giving you 44 cents per share per quarter, which I can tell you because I have VYM myself. Just remember, basing yourself off of just dividends is not always the best way to go, because all these dividends can always be cut by the companies. So for example, the financial industry right now, they're probably going to cut dividends for all the major banks out there like Wells Fargo, Chase, and they are well known for giving great dividends. I wanted to make this quick video, or as quick as possible, just because I've gotten a lot of questions from many people on what ETFs you should get or what ETFs I should buy because I'm a beginner or I'm not used to it. And this is honestly a great way to get into the market because, like I mentioned 30 times probably now, it gets you super diversified and your portfolio will thank you, and you reap the benefits of all of the companies. If they all grow, you grow with them. Obviously, if they all go down, your stock or your share of that ETF will also go down. But for the most part, remember, we're doing this for long term, so it averages out and it always goes up for the most part. Just remember, I'm just some random YouTube guy. I wanted to make this as quick as possible. If you have any questions, please leave them down below. Make sure you subscribe to get more updates and click the notification bell so you can get notifications every time I upload a video. I'm trying to upload as much as possible for you guys so that you can become wealthy investors and make a lot of money. And just like I'm trying to teach my wife and my daughter to make sure that they make great investments in their life, I'm trying to teach you as well. So I hope you appreciate the video. I hope you give it a thumbs up, smash it for the YouTube algorithm, and I'll catch you guys on the next one. Peace.